Bitcoin is up about 100% so far this year, and I think we should probably take a closer look at it, and we can also discuss the markets a little bit today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Today I'm joined by my good friend, colleague, co-author of The Options Edge, and professor at Rutgers University, which is where he's joining us from, Mark Guthner. Mark, welcome.
Nice to see you, Mike. It's nice to be here. Been a long time since we've done one of these, and I'm glad we're getting to talk about Bitcoin today because it has everybody's attention, and I think there's some stuff to talk about.
Yeah, I mean, its performance obviously is going to attract a lot of attention. Maybe before we get to it, you can talk a little bit. I mean, you've been, I would say, you're active in the space. You've followed it quite closely. You run some mining machines, I know. You run a fintech lab at Rutgers. You educate on this topic. You are also quite heavily invested in the space. So maybe you could just give everybody who's watching right now a little bit of a background on how you got involved in this and in what ways you are involved.
Well, I've always been interested in currency. I've read an awful lot of things from the Mises Institute concerning money and monetary policy. I've always been a fan of the gold standard. I don't like fiat currencies because they can just be printed. And it's a way of some third party extracting value out of the account of the economy, which is not fair to all of us that have to earn the money we spend, as opposed to running over to a printing and press and firing it up and getting some bills off and then running down to the 7-Eleven for a Slurpee. It's I like hard money, and so I was very interested when Bitcoin first came out. But that interest accelerated when I started teaching here at the school because they want me to teach financial technology. So that's anything concerning like payment systems, how exchanges work. Some stuff that we did an awful lot of work together in algorithmic trading and things like that. And then I said, the kids, that's all good stuff, but the kids will be very interested in Bitcoin, and why don't we add that to the curriculum? And so I started to spend more time there. And then I reached out to a number of companies and asked if they would donate some equipment to the school. And that started out really good and then turned into a disaster during COVID lockdown because all of a sudden everybody who I was talking to switched from love to help you out to I'm not sure we're going to be in business in 6 months because the supply chain died. But anyway, I have a lab where we run some Bitcoin miners, and the kids can take a look and see what's happening on the blockchain and dig into the database and things like that. We're going to do some other things as well, but that's sort of where we started. And as you know, and we've talked about this before, I use Bitcoin miners to heat my home. So it's nice in the wintertime. I turn them off, of course, in the summer. But I figure if I'm going to heat my house, I ought to get a little something back. Yeah, I've very interested not only in the finance side but the technology side.
So let's just talk a little bit about what fiat currency versus hard money, and the gold and silver are hard money not just because they're physically hard, but why don't you just sort of discuss for everybody who's watching, because there are people who are going to be watching this live. There are probably a lot of people who will catch it later, but they may not really have a good understanding of the difference. And for some, and we're going to talk about the differences and the factors that make Bitcoin attractive relative to conventional sort of old school concepts of hard money, like the precious metals. Why don't you just sort of go into that a little bit so people can sort of get a broader understanding of how we think about mediums of exchange?
Okay, so currencies are either are have, well, hard currencies, we've typically used commodities, and that's gold and silver, but they've used other things in the past, but primarily gold and silver. You know, we have nickels were made out of nickel, and that's where it got its name. And then pennies, we used copper for small transactions. But the point of hard money is that it takes work in order to create a currency. You know, one of the unfair things about a fiat currency system is all of us are in the system. Either we're making things or we're providing services, and we're adding to the system. And we take stuff and we get to hold our contribution to the system in currency and use that to get some goods and services later on. So it's a way of holding the energy we've put into the system until we want to use it. And what happens in a fiat currency system where the government prints money is they said, well, you guys have all done a lot of nice work here, but we're going to take a little bit for ourselves. It doesn't look or feel that way because you don't see it. Um, the money just gets introduced into the system, but the government did not have to provide goods or services to the economy in order to get that money. It created it. So it takes a little bit of value. When it does that, it takes value out of the economy, and that shows up by inflation. So we just see higher prices. The politicians always like to blame these things on innocent bystanders. You know, the latest one now is those greedy corporations. You know, it was really interesting.
Greedy grocers.
Yeah, the greedy grocers. It was amazing. For 50 years, grocers were not greedy, and then all of a sudden, they woke up one day and said, you know, they talked amongst themselves and said, "Hey, let's go raise all our prices and get greedy," which of course is nonsense. The inflation bout we just had came about because the government ran a huge deficit, and then the Federal Reserve, accommodated that spending by printing money and giving it to the government to spend. And so I like a system that is more honest, that if I save my money, if I get up, go to work, I do something, and I save my money, that my purchasing power will be preserved through time. And with fiat currency systems, you know, they say a 2% inflation rate is okay. Well, where did the 2% inflation rate come from? It's a magic number,
Yeah.
just pulled out of the air, right? There's no academic study that says to optimize the performance of an economy, you want an inflation of X.
Well, if you have 2% inflation on a $30 trillion economy, then you've imposed a $600 billion tax.
Yeah, and nobody knows they're being taxed, and that's, from the government's perspective, the beauty of it.
So I actually, you know, it's funny, just before we get to it a little bit, just in terms of addressing a little bit of the gouging aspect from the greedy grocers. I mentioned that because there has been some allegation on the grocers specifically, but I happen to have on my screen right now the net income margins for Albertsons and Kroger. So this is Albertsons right here. The trailing 12 month net income margin for Albertsons is 1.6%. And for Kroger, you know, it's an egregious 2.2%. So these greedy grocers are making 2.2 cents in profits, net of taxes, for their shareholders for every dollar of sales that they do. And it's funny because you hear that kind of greedy grocer stuff, and meanwhile, not a whole lot is being said about NVIDIA. And I'm not suggesting that NVIDIA is price gouging. They just happen to have the best product within their space, and in some cases the only product. But that's a company that's making, just for perspective, 56%. I haven't actually heard, although the FTC and the DOJ have started some investigations into other large tech companies at various times. Apple has seen some scrutiny, others too, but obviously there are businesses that actually do have huge margins. The grocery business and many of the businesses that supply the staples in general are some of the lowest margin businesses. And this shouldn't surprise us because these are the oldest services and products that humanity has provided in any society for a long time. These are mature businesses and highly competitive ones.
Yeah.
So, that's not really, it's not productive, but it's also entirely dishonest, I think, for people to suggest that. Anybody who thinks that 2% net income margins is gouging probably needs to have their head examined
Yeah.
or their trustworthiness questioned.
In those spaces, if I recall, Costco is about 10%, which I think is a very generous number. And I always think of a good business has a net profit margin of about 5% or better. That's sort of my rule of thumb.
Costco's is 3%.
Oh, is that all? Oh, okay.
Yeah.
That was more than that. Okay, so
No. And one of the reasons it is higher and more consistent is that they have subscription fees. And the market tends to assign a much higher multiple to people that have, call it a SaaS model, where there's a fee that people pay recurrently regardless of how much they spend. So that's basically revenue that's going to be unimpacted by supply chain issues, by commodity prices, by product disruption, all of that kind of stuff. Mm-hmm. You're basically getting paid to provide the service of having a warehouse. So anyway, having spoken a little bit about inflation and the ideas behind hard money and invisible taxation that can come along with fiat currency and the impacts of inflation, let's talk a little bit more about Bitcoin because, Bitcoin has some attributes that are really important that precious metals do not. So, for example, it's difficult to make payments with gold. Even if we went back to something where we actually use gold coins, that's hardly practical, is it? And if you want to move large sums of it, it becomes even more challenging. So what are some of the key benefits that Bitcoin offers in terms of, a hard currency that, other than, it's not heavy.
Right. It's,
that, you think are important to creating its value as a medium of exchange.
Yeah. Well, I kind of think about it as simply gold in cyberspace. And so it doesn't have any mass or doesn't exist in 3 dimensions, right? That's kind of how I think about it. And it has that attribute because there's a limit to the amount of Bitcoin that can ever be produced. It's 21 million. But you also got to do a lot of work to go create a Bitcoin. So to pull something out of a new Bitcoin out of cyberspace. And so that's where it has something in common with gold. It's limited in supply. Now, some people say, well, gold's not anywhere near as good because the gold supply goes up by 2 or 3% a year. I'm not that much of a purist to say that that's bad, or maybe it's not quite as good as Bitcoin, but it's certainly not a problem, and it's a million times better than just being able to increase the supply of currency at whims. We know paper currencies don't work. Zimbabwe blows up, Argentina blows up. These countries get into financial trouble. They can't pay their debts. They print a lot of money. They have hyperinflation, and then they issue a new currency and start the process all over again. So they have what they have in common is that they are limited in supply. Bitcoin is more limited because there's ultimately a cap on what can be created.
So this gets us
the fact that it's electronic, it's easy to move around.
So this gets us to, I think, probably the thing that interests people the most when they're thinking about Bitcoin and everything in the complex. So the number of instruments that people have access to is just consistently being enhanced. There are essentially service providers that are within the ecosphere. That would be the miners. That would be outfits like Coinbase, for example. There is, of course, Bitcoin itself. There are now ETFs on Bitcoin.
Mm-hmm.
There
Yeah.
are other types of proxies, companies like MicroStrategy, for example, which we're going to get to because they have a very interesting kind of business model that also has important implications for the value of Bitcoin because it helps create demand when you can include more potential investors in the space that otherwise wouldn't have access to it. And that's one of the things we currently have, right, is a lot of restrictions on who can access it, whether or not you can use conventional banking to, to purchase and sell, whether it can be transferred in this way. Those things are all challenges. So what I'm really hoping to get to, and one of the important distinctions I want to make between gold and silver, I don't mind that we mine silver, that we mine gold, and that we would also use it as sort of the underlying valuation for our medium of exchange, because as long as the respective supply of the underlying asset doesn't grow considerably faster than the economy in general, its value doesn't get diluted. But
Mm-hmm.
where Bitcoin is concerned, if you use the exact same logic, so in other words, if the global supply of gold grows by, call it 3 or 4% each year, but the global economy grows by 3 or 4% each year, then the respective value of an ounce of gold in terms of its purchasing power is probably going to remain relatively stable. In the
Yeah.
case of Bitcoin, because the total amount is finite, 21 million, then as both demand for it increases, as its adoption increases, and as the economy grows, then there's really only one, assuming it becomes a de facto medium of exchange, then there's really only one place for the price of it in fiat currency terms to go, and that's higher, right? Because the supply, there's a theoretically infinite supply of dollars, of euros, of yen, of yuan, etc. But there's a
Mm-hmm.
finite quantity of Bitcoin, and it also has a lot of utility that those other currencies don't. You can transfer it. There was an ad many years ago by Visa. Their motto was Visa. It's everywhere you want to be. But the
Right.
truth is that Bitcoin is probably the money that is, in fact, everywhere you want to be without as much government control. So if you try to wire $100,000 to somebody, not so easy. If you try to carry it on a plane, that's nigh impossible. Same thing actually in terms
Right.
of gold. It's not that easy to transfer. Bitcoin, it is in fact much easier. So not only is there a reason to understand how it might preserve its value, but there's real value in the ease and security with which it can be used to transact. So this is where I know you have a lot of models that help us understand how we might think about the value of Bitcoin, because we can talk about its benefits, but we really want to start thinking about how do we think about what a Bitcoin is actually worth. And I know you have some material for us on that, and maybe we could get to that. How should one think about the value of Bitcoin through time?
Well, that's the medium of exchange is what we often talk about for currencies, but store of value is also important too. There's this whole idea that 200 years ago you could buy a high quality suit for 1 ounce of gold. Very high quality suit still cost you an ounce of gold. And so that if you were holding gold, that it preserves its value over long periods of time. Certainly, over short periods of time, the price fluctuates all over the place, and because it is just gold is an asset, and sometimes it's in favor, and sometimes it's in not, as well as having its valuation advantages. So, um, that's the way I sort of like to think about it. I think. Why people are starting to think about Bitcoin is it does take us back a little bit into the times when we had a gold-backed currency. So if you think about interest rates from the founding of the country till 2013. The average interest rate in the U.S. was something like 4.5–5%. So you could have um, deposited your gold with a bank. You could earn 5% on it. Its value maintained itself. We even went through that period of time as well. We had no income tax, so that was a real gain. You were rewarded for savings, and that's sort of very valuable because that means people can spend their time doing either taking care of their family or taking care of their business. But every one of us now has a second job, and that is managing our money and being our own money manager. So um, over time, we've figured out that well, we better not save, but we better save and invest because we need to put the money to work so it gets a return at least as high as the rate of inflation after tax. Otherwise, we're not being rewarded for savings. And so I think the first chart I have is the chart of the S&P 500 that we have, and we've gone through a very nice time period here. Let me just fix my screen. Okay, it starts in 1991, and you can see the price goes up and down. There's some pretty big swoons. There's one after the dot-com bubble from 2000 to 2002. I think that was about a 50 or 60% drop. We had another 50 or 60% drop in 2008, and then ever since then, it looks like investing is an easy game. Go buy the S&P 500 and call it quits, um, and which is fine. I think putting your money in the S&P 500 and investing in the 500 most successful companies in the U.S. Is a good strategy, especially for those that don't have the time or the inclination to want to be actively manage their money. But the point of this chart is if you look at this, you'd think like, you know, wow, what a huge winner. I started out here at, I don't know, 300, 400. Now we're at 6,000 on the S&P 500. Well, let's take that chart and now take the S&P 500 and divide it by the money supply, M2. Um, and this is a very interesting result. So the price of stocks relative to the amount of money in the economy peaked at the dot-com bubble and sold off harshly into the financial crisis low. And it's been growing ever since. But when I see a chart like this, it makes me wonder how much of that return that I got in my S&P 500 came from those companies creating value, and how much of it simply came because there was an increase in the money supply. This suggests that most different, if not most of those gains, are coming from a money supply. So I like to look at money supply when I think about prognostication and forecasting the stock prices. With money supply going up, there's a tailwind to investors' backs, and you should expect higher prices over time. So one of the things that we like to look at as well is that SPX. We'll look at the S&P 500 relative to the CPI. Now, the CPI grew at a slower rate, as you can see, than the money supply. I'm sure that's going to Mike's earlier point that if the economy is getting bigger by 3%, and if the money supply grows by 3%, why the price level is probably not going to change very much. And inflation will be, or price inflation, is like we like to call it, PPI and CPI, aren't going to change very much. And um, so we see that S&P 500 is outperforming CPI, and of course, there's always this debate going on whether or not CPI actually measures the rate at which prices are going up. The government's changed the formula 2 or 3 times in the last few decades, and that I find a bit troubling because it makes numbers today incomparable to numbers in the 40s and 50s because we use different formulas.
They're moving the
Um,
goalposts, usually
yeah,
in their own favor, it should be said.
yeah. So, and it's in the government's benefit to do that because if people are making more money because prices are going up, the government indexes the tax tables to the inflation rate. So if I'm making more money from inflation, say 10%, but CPI went up 5, they raised the the cutoffs for the tax tables up 5%. Um, the government is going to increase its tax take when they do that. So they get an advantage for doing that. And also, they index things like Social Security to inflation. And so the amount that the beneficiaries get is less if they suppress the CPI. So I don't want to get
So if
into
I could
the
just
debate of all
well, if
that.
I could just summarize what yeah, if I could summarize what you're saying, basically, if the official statistics on inflation understate what's actually happening, then all else equal, from the government's perspective, it reduces their liabilities and increases their tax revenue.
Yeah, that's right. Oh, you said it much more eloquently than I did. Um, so this, I think, is one of the reasons why people are getting very interested in Bitcoin, in that they've seen it essentially just go up since its creation or discovery. Some people like to call it a discovery, and in 2009. So if we look at the next chart, this is the price of Bitcoin. Now I got this chart from um, this group called Plan B. They do some interesting work on valuation, and so I'm going to walk through um, their thought on this. It's very hard to figure out what a commodity should be worth. What is a fair price for gold? Um, it's hard to say. What's the fair price for silver? What's the fair price for oil? We see them trade in the market, but we're not able to do a discounted cash flow analysis like we do to value stocks. And so there's not a clean and easy way to do that. But one of the attractiveness is why I think people are getting involved as Bitcoin is if you hold Bitcoin long enough, you're going to make some money and you'll make a lot of money. So if you look at something like a year after Bitcoin was introduced to the world to today, it's averaged something like an 80 or 100% compounded annual rate of return, which, if that goes on long enough, that gets people's attention. What I have here is the price of Bitcoin, and the black line there is the 200-day moving average, and you can see that it's moving up from lower left to upper right, which is the definition of a bull market. And then, as I have heard other commentators say, that if you hold Bitcoin for at least 4 years, you're always going to make money, or at least you've always made money in the past, let's say. And so, as it becomes easier to get a hold of, both from the getting, buying it on an exchange, holding it in your wallet, things like that, this adoption, um, um, I think that's one of the things that's driving the price higher over time. That the adoption, when I see this steep rise, I'm not seeing an inflation hedge. I'm seeing a progression of adoption where nobody knows about it in 2009. Almost nobody knows about it in 2017 when it started its big run to 20,000. That got it on everybody's radar screen, and now people watch it, but nobody has an idea of what it should be worth. But we see these fantastic predictions of what the price could be one day. And so I'm looking at one of the ways people like to look at these commodities is through the stock to flow model. And essentially, what they do is they um, take the stock, which is in this case the amount of Bitcoin outstanding. For gold, it would be the amount of gold that's been mined, and then the flow is the amount of new creation. So when miners mine, they get a block reward. That block reward goes down every 4 years, and so the rate of increase slows down. And so if we take the stock divided by flow, and then we do a correlation with the price, we get this little formula here where Bitcoin is equal to 0.25 times the stock to flow ratio raised to the third power. That is the gray line you see in this chart. So what we have here on each one of those jumps is that's when at that
The halving.
period where the number of Bitcoin getting created every time a block is processed gets cut in half.
Hmm.
So its price, the amount of Bitcoin getting created is slowing down. And it's only now something like 1% or 1.2% of the amount growing out. But what I did wanted to point out is this is what's getting people's juices flowing when they see the price start to run, because this model is telling you that at the end of this halving cycle, they call it, the price of Bitcoin, if it follows past behavior, it's going to sneak up to something like $500,000 a Bitcoin over the next couple of years. And the people have been watching it have are now starting to get excited because we're seeing that move. Notice in this chart that when the halving takes place, the price starts to go up slowly and then it accelerates. And then about 18 months after the halving, it kind of hits a new, let's call it equilibrium for a lack of a better word. The little chart on the bottom, by the way, is simply telling you the little white dots, how much the actual price of Bitcoin, which is all the colored dots, deviates from what the model is suggesting. So it's saying way below what the model's suggesting right now. So
So in other words, may I ask you a question then about
yeah,
what you're suggesting here? So just in terms of, so if we think about this as sort of a cyclical timing mechanism, one way to think about what we're seeing here is that there's a price acceleration that would correspond to a halving that is theoretically, if the future follows past patterns, that we're on the cusp of one potentially, so that you begin to see that sort of step change catch up to that new sort of theoretical level based on the stock to flow model. Is that the right way to interpret what we're looking at?
yeah, that's right. And as the let's call it the inflation rate of Bitcoin gets smaller and smaller, that makes the Bitcoin more valuable. And bear in mind that M2, I think if you go back 20, 30, 40 years, it averages something like a 6 or 7% growth rate. So Bitcoin is becoming much more valuable relative to dollars from a supply standpoint. That its supply is growing much less, and eventually its supply will growth will hit zero.
M2 is growing at 6 to 7% annually over
I
the
think
course of the last, call it 35 years or so.
something like that. It's a very high number. Yeah. I
That's
if
alarming
too high,
because
that too
well,
high.
it
It's just
feels
that
high.
yeah.
It feels high. Here's why. To me, and this is my intuition, but I could be wrong on it. One of the reasons you had said earlier that for passive investors who are not particularly interested in identifying investment opportunities or investing or speculating, as self-directed investors, buying the S&P 500 is a wise choice. I have two reasons for believing that. And one of those reasons is that, first of all, the way the S&P is constructed, it automatically collects the publicly traded winners and weights them appropriately. So
Hmm.
when NVIDIA, was first created, it's essentially a nothing component. But as it succeeds, it becomes an ever larger component. And so basically, the cream rises to the top, and the S&P as a cap-weighted index means that, by and large, the bigger the winners become, the more you get to participate in their success. So that's part of it, which is another way of saying, why not just buy the best performing companies? Now, it would be, of course, great if you could identify them before they become that, but
Yeah.
if you're not a successful venture capitalist, my own efforts to invest privately in VC opportunities, I wouldn't describe that all that favorably. My success in the publicly traded markets is considerably better. It's not easy to try to pick winners before they go out and win. So it's a little bit like getting long Tom Brady after he won that first Super Bowl ring, rather than speculating on him when he was still at your alma mater, Michigan.
Yeah.
So where he was warming the bench for a little while before he sort of worked his way up. I guess that's one part of it. The other part is that because of that, the earnings per share for the S&P has typically grown much faster than the headline nominal growth of GDP of the country overall.
Okay.
So one way to think about that is that, typically the S&P has grown over the last 30, 35 years. Their earnings growth has been in the neighborhood of 6.5 to 7%. And if we think about it, then maybe the U.S. GDP grows nominally by, call it 3 to 3.5%, and then we understate inflation a little bit. So my way of thinking about it would be that if you tacked on an inflation rate to the GDP growth, I would have thought, if someone had said to me, just guess, Mike, guess what the money supply's growth rate is, I would have said nominal GDP plus CPI, right? So that would get me to like what, 5.5. So
No,
a little bit less.
you want real GDP plus CPI. Gets you to nominal GDP.
Well, I think of real as an inflation adjusted. No, I'm talking about
Inflation
I'm
number,
tacking
real
inflation
GDP
back
plus,
in.
Yeah. Yeah.
So that would get me to about 5.5, 6%. Does that seem?
Yeah, and so I think
A little bit less than G. So I was my reason for suggesting that people just, if you're not going to do anything else, and you're not going to trade options, and you're not going to try to get more sophisticated or trade other things, that the benefit that the S&P has generally offered is that its earnings growth has exceeded, because you're dealing with the winners primarily, has exceeded GDP growth plus inflation. And that's kind of your objective, right?
Yeah,
So as an investor, at the very least, for preserving your value or growing it a little bit, you need to beat those two numbers, or you're falling behind. So, but you were saying 6.5 to 7%. That's actually scary to me, and maybe it's true. It probably is true if you think about counterfeiting in places like Africa, where they try to use dollars as their medium of exchange, and not all of them are real. But that doesn't necessarily dilute us. In other words, if people are using it as a medium of exchange outside of our own economy, it doesn't necessarily have a hugely pernicious effect straight away. But Bitcoin doesn't have that. Okay, so sorry for that little sidebar, but I thought that was very interesting.
That was excellent. The interesting thing here is I had never heard of this stock to flow model until I started to investigate Bitcoin, and it seems that that's a method that people had used for valuing, putting a price on gold and silver, copper, palladium, platinum, precious metals. And it also works for asset classes. It's not on here, but people will do the same with real estate and stocks. They'll fall on one of these lines. And so the upper line shows if we applied the stock to flow model relative to gold, diamonds, silver, platinum, palladium, and you drew a line, you get that line up at the top, which is log of Y. That's the log of the market value. So it's the full size of the asset class. times 1.67 times the log of the stock to flow ratio plus 23. Uh, and that R squared is pretty doggone high. And so there must be something to it, but um, I don't really understand why it works because it's really just looking at supply. Normally, when we think about coming to a price, there's supply and demand. So now this model doesn't work if you're talking about products that might be limited in supply. Let's say lead, but um, nobody cares about, or in other cases, other cryptocurrencies. This it doesn't apply. It just seems to apply to Bitcoin. I've tried to take that model, apply it to Ethereum and Litecoin, for example, and the connection is not nearly as strong. Um, then, so on this chart, so I had this is the way the world is valuing these commodities. And then that other chart with the steeper line on it with all the colored dots on it, that's how the stock to flow ratio has changed through time. So the stock to flow ratio was really low when it started out, right? Because there were very few Bitcoin, and every time a block was processed, 50 new Bitcoin sprang into the world. Now that's only 3.125 every time a Bitcoin is created. And it's followed that kind of steep line. It's a pretty good fit at 0.95. So there's something to it. It's one of these things I'm researching. I would like to know if there's some intuition about the calibration of the model. For example, what does the 3.52 mean? Is there a way for us to by using some other method, come up with that curve fit? Because these are just curve fitting models, and I'm always skeptical of things that are just a curve fit. I want a theory, I want some data, and I want them to line up and match. Um, and so at this point, this is just an observation. But the final point that I would want to make is like the stock to flow right now is a little over 120. So if we look at that chart, can we go back just a second? It's predicting a price of something like $10 billion. So if we take 10 billion and divide it by 21 million, what do we get? Let's 10 divided by 0.21. We're going to get something like 5 or 6, 700 thousand. Oh, we got to take the log in there to do that computation for price. But it's telling us something about scarcity, and it's one of the reasons why people predict these fantastic prices is because they have a model like this. They extend it out, and so will gold. So anyway, the point that I'd like to make is I think the bulls are hoping or expecting that the price gets to somewhere around $500,000 by the end of this cycle for the next 18 months. And then on the last chart, that same chart by the same fellows that does this, you can find his, you can subscribe to his work. I don't know his real name, the fellow's real name. He just goes by Plan B. He created took that cycle and then created a trading strategy with it. So basically, he said, if I buy Bitcoin 6 months before the halving and hold it till 18 months after, so 2 years, I'm going to get a return that looks like that green triangles. Has a very nice rate of return. If we avoid the other time periods, we would get returns, and that's when we held it. We would get the returns based on the red triangles there. So half the year essentially Half the cycle, nothing happens or it loses some money. Half the cycle, it makes a lot of money. Um, and so I just thought I might share that out there. I have no idea if it works. We've got to put the disclaimer on that past performance is not
Hmm.
necessarily indicative of future performance. But you can see this with people witnessing something going on, that more and more people say there's something to this, and they want to get involved. And now that we've got an ETF, people can
Well,
do it.
yeah. So, if I could interrupt you for a second, one of the things I thought we might do is we've spoken a little bit about theory. We've sort of spoken about sort of I mean, what is money? What's real money? You were just talking about the supply side. Let's talk a little bit about the demand side. Now, there's a couple things I'm going to introduce here, which you and I are going to have to discuss on future streams in greater detail, but I think they're very important. You just highlighted one, which is the introduction of ETFs, creates a vehicle for people who are interested, who were either unable or unwilling to participate in the space by going and purchasing Bitcoin, by getting a Coinbase account, by finding other mechanisms to invest. The ETF is certainly one of those mechanisms, to be sure, but there's a lot of other ones too. To me, and I know you're an investor in MicroStrategy, I think what Michael Saylor is doing is one of the most fascinating things I've seen. First of all, he was an early adopter. He sort of understood what was happening. But I think a lot of people don't understand what's happening with MicroStrategy itself. And there is a little bit of a spread between the theoretical book value of MicroStrategy. So if we think about a MicroStrategy as a proxy for Bitcoin, you have a business, it goes out and buys Bitcoin, Bitcoin rises, the value of the business is greater, simply because the book value of the Bitcoin they hold is going higher. But what he's done that I think, other than creating, in a way, MicroStrategy was kind of the first Bitcoin ETF, because you could just go out and buy and sell the stock. So now you actually had a proxy for Bitcoin that traded like a stock. And in fact, it was kind of the de facto ETF. But what he's done since brought in a whole new class of investors. So you and I have both served as institutional investors running regulated funds. You managed pension plans, Taft-Hartley pension plans. I've run a 40 Act fund myself. These are restricted entities, and there are many investors who are restricted. They could be restricted because they have an IRA, and their IRA will only allow them to buy or sell certain things. So if you wanted to buy Bitcoin in your IRA, buying MicroStrategy was a whole lot easier. But one of the biggest classes of institutional investors in the world are fixed income investors. And a fixed income investor is, and you've been one, is heavily challenged by the impacts of inflation. So Bitcoin would be an immensely appealing hedge against inflationary risk, an alternative to something like TIPS within your portfolio, which are only going to give you a very, very marginal rate of return. But the thing is, they couldn't access it. If you have a mandate and you are a fixed income investor, that is, you buy bonds, you buy commercial paper, that's pretty much all you do, how do you have access to this? It has huge utility for portfolio management, but you don't have access to it. What Michael Saylor did was he started issuing convertible debt. MicroStrategy was selling convertible bonds with a 1% coupon, and effectively the buyer of those bonds was getting a 1% coupon bond plus a call option on the value of Bitcoin. And it's just, for those of us who are also options traders, this has a couple interesting implications, right? Because number one, it brings in a whole new, very sizable class of investors into the space so that affects the demand equation immensely, right? If you have $1 trillion worth of assets that suddenly say, hey, I have a mechanism to participate in this, even if in small size where I never was able to before. Even a small allocation, $1 billion fund manager says, I'll take a 1% stake. That's $10 million worth of incremental demand. So that is hugely impactful all by itself. There's another interesting impact, which is that convertible bonds, because they incorporate an embedded form of an option, now are creating a new sort of volatility asset on Bitcoin as well, which has its own implications too. So I wanted to throw that out there before I wanted to talk about some other, just get your very quick opinions on a couple things that are related to this election and the implications for Bitcoin. Because I think we can agree that the candidates, while generally supportive of cryptocurrency, that the incoming administration has expressed certainly a much more enthusiastic and potentially bullish perspective on it than Kamala Harris's team did. Some of the things that got mentioned, and maybe the biggest from a demand perspective, was the topic of a strategic Bitcoin reserve. What do you think there is any chance that, I mean, Trump did mention it, not committed to it as a policy. What do you think the chances are that there would be a strategic Bitcoin reserve? And can you describe for the people who are watching and don't know what that would mean? What is that?
Well, right now we have a strategic reserve, and it's called gold, right? We're hoping that it's still there at Fort Knox. There's always those conspiracies that somehow it's been carted away. But let's presume that that is there. That is a reserve that the country could use if it needed to pay a bill in which people would not accept the U.S. dollar. So it's a reserve asset. A lot of countries do this. So if you're, let's say, Indonesia or Brazil or something, you hold U.S. dollars because a lot of people don't want to take Brazilian real or Indonesian rupiah for settlement of payment. They want dollars instead. Well, you would, in this case, they would hold Bitcoin, and the idea that they put forward is that the federal government would accumulate 1 million Bitcoin over 5 years, which would be really remarkable when you think about it, because there's only 21 million, and of course some have been lost because people lost their wallets and the passwords to their wallets, called keys. So in any event, let's just call it 20%, the 5%. They're going to go buy 5% of that. Then that's, of course, a huge amount of demand. But there's also other countries that would say, hey, if the United States is going to do that, why shouldn't we do that? And I think it's a very interesting notion that a small country kind of figured something out. El Salvador is they were basically saying, we're going to take all our extra money and we're going to own Bitcoin to it. Now, now I'm not aware that they have done this or any country has done this, but let's say you are a country, and countries typically have their own currency and they print their own money. Why not print some money, buy some Bitcoin? And that's effectively what the U.S. government would be doing it, but on such a small scale. But El Salvador is so far a big winner on its Bitcoin strategy of mining in country and making a small purchase every day.
I think one thing I would say about this is that, I've heard some people say, "What? We're going to spend money on Well, no, we create money, we print money. From a balance sheet perspective, it's not deleterious necessarily for Treasury to say print $1 billion and receive $1 billion worth of some asset. Not in theory, in complete isolation, that hasn't really created too much of a problem, mm-hmm. Right? What are the potential impacts? I mean, you're throwing currency into the ecosphere of Bitcoin in this particular example. The recipients of that billion don't know exactly what they're going to do with it. If they just go out and start spending it with impunity, that could, in theory, be mildly inflationary. But if you take a long, just taking a look at the charts that you were previously showing, if you take a long look at it, you have to say that the liability, that's the dollars that you printed, are going mm-hmm. to likely depreciate relative to the asset. That's the Bitcoin you
Yeah.
accumulated. And so, from Treasury's perspective, over time, you're a winner. And the thing is, people often say, "Don't fight the Fed. Don't fight the Fed. Don't fight the Treasury," because
Yeah,
they
that's
can
right.
make
Now
themselves
don't fight.
they can make themselves winners, right? It
Yeah.
doesn't ever have to be a loss if policymakers decide it won't be,
Yeah.
which is kind of a remarkable thing in and of itself. Something else. Um, And these are things I hope we are going to talk about in future live streams, because I see we're coming up on an hour. But here are some of the other things that I think people would hope for, which is that the transactions in them, that it would be treated more like a currency and that there would be no tax.
Hmm.
I think something else that would be very important is in terms of regulation. I ran an ETF, so allowing in-kind transfers, deposits, and withdrawals using Bitcoin, I think, is kind of a critical thing that financial regulators have to get their arms around. But there were two things I wanted to ask you about before we leave, which is, sort of clear and transparent stablecoin regulations. What are stablecoin, and DeFi regulations, and of course allowing, and finally, and this is maybe the most obvious thing, which is allowing banks to do it. Because I have friends, I'm friends with Brian Kelly, for example. He runs a hedge fund that focuses on crypto, and it's a challenge. If you bank with JP Morgan, and you have institutional customers, you can't use the conventional major money center banks for this. And of course, one should be able to. I mean, it's astonishing to me that at one point you would be talking about the possibility that the U.S. federal government would consider putting in place a Bitcoin reserve, and at the exact same time, you can't bank freely through JP Morgan or Bank of America or Wells Fargo and transact in the space. That seems like insanity.
Yeah. Well, it's inconsistent, and that's for sure. And maybe that's what breaks the logjam, and we get uh, some clear regulation around around whole space. Bitcoin is much different. We haven't gotten really into tokens and how they interact with various ecosystems. They're going to need some regulation so that people understand what it is that they're buying. I think we do a lot of stuff with the law school here. And every Friday we have um, a seminar, and somebody comes and speaks for an hour on some aspect of the law of cryptocurrency. And I've my opinion has changed quite a bit over time as I've listened to various lawyers, because I think there's just a gap in the law. Um, there's some things that, like, a token seems like a stock, seems like, that is like that. It's like ownership, but it doesn't. A lot of times they don't have ownership or a claim on the underlying asset. Um, and so, what is this thing? And so, the world needs some regulation that defines what they are. I've kind of come down on the fact that if you're looking at all these different projects that are running around there and they like to issue a coin, I think of them as frequent flyer miles. That there's something that exists inside an ecosystem that you use to navigate what you're doing, whether it's buying a suit of armor in a game, or you're buying an airplane ticket.
You're buying Pinduoduo or Baba.
Yeah.
Yeah,
So,
because I mean, actually, a lot of people don't realize this. When you go out and you buy Pinduoduo, PDD, or you buy Baba, or you buy any Baidu, you buy a Chinese company's stock. That's what I think. When people go out, and they buy these things. That's what they think they're getting. But the regulatory gaps that exist between the concept of share ownership in China and how investors are allowed to participate in the market, and how international investors are able to participate, is that it's not quite the same thing as buying
it's
a
not.
share in a U.S. company as a U.S. investor. What do you really own? And I think, these are gaps in the law, international law and domestic, where people's understanding of what legally own and have a right to when they purchase something isn't always clear. And I would hope that any effort to make our capital markets more transparent and more effective would help clarify a lot of these issues. So we're coming up on the hour that we would normally take, and I would love to go all day. But I know you probably have lectures to give. It would be terrific, by the way, if you think maybe we could get one of those law school professors to participate in one of these things and have a conversation about that. And maybe we can even get some questions from viewers that they would like to have answered on questions like this. I think that would be really, really helpful.
Okay.
And let me just quickly take a peek. Yeah. So we have a couple questions. So let me just throw this up here for a second. So Seven Figure Submission asks us, pleasure as always, Mike and Mark. I know you're just getting started. Question for Mark. I'm curious what an economic shift towards a full digital society looks like.
That is very big. Maybe the world looks a lot more like Facebook and Google, where everything is virtual. I don't know. One of the things I think is really interesting is the idea of a decentralized autonomous organization. Think of Mike is his wife. His wife owns a Tesla. So what Mike decides to wake up in the morning and he turns on a little piece of software and says, "Our Tesla is now a taxi." And I've created a corporation, and the asset of that corporation is the car, and it connects to a piece of software that Tesla put out there. So what does the car do? So the car gets a signal to go pick somebody up, take him for a ride. That guy pays electronically for his services when he gets dropped off. The company needs a charge, so it runs over to a charging station and charges itself back up, and then goes out and gets more customers. At the end of the year, since everything's electronic, it can electronically file its taxes with the federal government and hand over some of its money. When the car needs service, it knows that, so it drives over to a service station, gets new tires, whatever, fixes the brakes, cleans the thing, whatever. So I just described a world in which there's no people.
Teslas, by the way, you don't need to work on the brakes too much because the car almost never uses them. So we're on our second Tesla, as you point out. I used it on very small B/C type roads yesterday on full self-driving. And the reason I was doing that was because my wife had blocked my car in. So I had to use it to go take my son someplace and back. And on the way back, I was like, oh, you know what? I haven't tried the full self-driving. So I think I'm going to do that. And I'm talking about roads with 5-way intersections, 25 mile an hour speed limit, hilly, curvy, the whole thing. Just car driving itself, comes to a stop, waits, looks, nobody's coming, goes. It's amazing.
Yeah.
It's just amazing. And the only reason it was the first time I had done it was because my wife is petrified of full self-driving and refuses to use it. So every time I've wanted to be in the car and say, hey, let's see what this thing can do. Now, granted, it being my first time doing it, of course, I was covering the steering wheel. I was, covering the pedals. But, Teslas don't use the brakes very often because they slow by generating electricity. And so you actually, sometimes what happens is the car goes into a mode whereby it actually stops doing that as much, and you're supposed to use the brakes just essentially to rub the rust off of the discs, because they really just don't get much use, which is quite remarkable. Our last one, the only thing we did to that car while we had it, The only thing we did was replace the washer fluid, because that runs out eventually, and replace the tires.
Yeah.
There was it never went in the years that we had it.
Yeah.
There was no service. There was no nothing. And so far, we have a 2024 model that we got in late 2023. The same thing is true. So anyway,
but one last point on that is that there's now opportunities to create companies that have in which that machines run the business, and that means machines got to have money, right? Because machines are going to interact with other machines to provide goods and services. So it needs a money. So there's going to, one of the things that's going to come out of all of this is there will be some kind of digital currency that lubricates that whole process. And whether or not that's Bitcoin or it's something else is
how machines interact and exchange work, compensation for work that they perform.
Yeah. So if the machine's running over to get repaired, then the machine is just going to pay the repair shop for whatever repairs it got. The machine knows to do that.
And the machine may be accumulating some resources for the work that it's performing autonomously.
Yeah. So it's kind of a strange world in all of that. So that's where I think some things are going to happen. I think international trade will get better because it's going to lower the cost of transactions. Now, we all use Visa, American Express, and they charge anywhere from 1.5% to 6% of the value of a transaction. So just think about the profitability improvements of retailers and folks like that. If they can get a system of payments where they're only paying 10 or 20 basis points to settle a debt. So instead of going, that can be a very huge change in the way people do things.
Yeah, I mean,
and, there's lots of stories to be told.
I saw an image of Putin with the leader of India. They were talking about, because my understanding is that Russia has a decent amount of money tied up in India, and there's conversations going on. One of the things that is unanswered, and I think is going to be subject of much debate, is to what extent will governments be able to see and regulate transactions within the space? Because one of the most appealing things, of course, about Bitcoin is that it does not reside within their control. And that's something that fiat currencies, they have complete control. They can control the size of transactions that banks are allowed to give. I think Nigeria and some other places, they actually have regulations that restrict how much of your own money you may withdraw from your own accounts, which shows you that it's not really your money and it's not really your account.
Yeah.
If it was, you wouldn't have that. So yes, as Tucker D. Dog says, Russia, you have a lot of our money. We want it back. This is a very curious thing, that effectively you can do all of this work. You can perform all of these goods and services. You can essentially try to store that which you have created and then use it at some future time. But for as long as it's regulated, there's entirely the possibility that it will either be eviscerated or regulated in such a way that you cannot use it to your own for your own purposes. And I think that's one of the most compelling things that Bitcoin offers, and I hope it is preserved. So maybe we can leave it there, and I really hope we continue this conversation, because I want to talk about DeFi. I want to talk about Know Your Customer. I want to talk about issues related to custody, borrowing, lending. You were talking about people being able to deposit gold in the bank and earn a 5% rate of interest and have an underlying form of money that wasn't diluted. All of those things, if we could return to a world like that, it would be quite extraordinary. And I think a lot of people probably fail to recognize. I'll leave people with this idea. And this is kind of my optimistic view for the future. At a time when there's a lot of people who are overwhelmingly pessimistic about things that are going on because we have massive debts, they're pessimistic because they don't like who got elected, or maybe they're pessimistic because they don't like who got elected is appointing, because I will say that I personally had a little bit of surprise that Matt Gaetz, that appointment caught me off a little, I have to say. Surprised me a little bit. Didn't exactly seem to be reaching across the aisle. But my point is this, and that is that every rapidly industrializing and growing nation in history, including this one, greatest nation that human civilization has yet created, one of the things where we saw the sort of the effective rate of growth in some ways get curtailed was that we had this sort of manipulation of money. And I actually feel that we could see huge improvements in a lot of places that have been corrupted. Perverting how people invest and save is not good for economic growth. No. And if we can get back to a place like the one that we were in, there's a decent chance that the growth rate could increase tremendously, combined with massive technological improvements. And if you want to solve the problem of our fiscal problems, for example, debts and deficits, growth is the only solution. We cannot shrink our way out of the debts we have accumulated. We can only grow our way out.
Yeah.
That's my last thing, and I really want to thank you for taking a full hour of your time from your office at Rutgers to talk about this, because these are really important topics. And also, we're just talking about one of the most profoundly exciting places for people to invest and deploy their money that we've seen, and it continues to be, and I think it will continue to be. So thank you very much.
You're welcome. Enjoyed the conversation. Have a great day.
Thank you, everybody, for watching. We will see you on Monday, 4:15 Eastern Time. Thanks for watching.